Good morning, traders and investors. My name is Roger Scott, and today is Thursday. It is June 3rd. It is the third trading day of June. And remember, we had a holiday weekend. We had a long weekend. And as I mentioned to you, whenever we have a day off, we always have a fragmented week, and it always takes a few days for things to start coming back. And it looks like finally today is the day that institutional trading is coming back. The Dow's down about 240 points. The Nasdaq's down about 150 points. Even the S&P's down 34 points. And the Russell, not as much as I expected, but it's still down. It's going to be a very interesting day. I wouldn't put too much weight into the pre-open because, again, it could be that there's a huge orders coming in, institutions are coming back in, liquidity is moving back in, so it may take a few days to get the liquidity and the volume back. So be very cautious, but don't make big waves out of what's happening right now. Take it into account, but don't try to extrapolate a long story out of this action. It could be just volatility increasing and funds coming back and offsetting some positions that they haven't seen in the last few days. Now, the big report today is jobless claims. Jobless claims numbers have been going down. They're in the 400,000s, I believe, right now. They kind of went from 800,000, 700,000, and then all the way to 500,000, 400,000. I like this. I like that there's not a lot of people applying for jobless claims, but at the same time, there's not a lot of people getting jobs. So it's a very interesting position we're in right now. I'm hoping it's going to come out in about 14 minutes. I'm hoping that the number is going to be right around 400,000. Honestly, truthfully, based on what we've seen the last couple of weeks, maybe a month, the number's down pretty good. Even if we're at the 4-week average, even if the number's a little higher, I mean, this is a really crazy range here. But if the number's around 400,000, 500,000, that's okay because it's moving down, and it's moving down pretty well. So again, anything around the 4-week moving average, 400,000, 450,000, 425,000, if we can break it and go into the 300,000s, that would be even better. But that's going to be the big report this week. We also have manufacturing data and productivity costs, but that's not the major report on the table. We know there's inflationary pressure right now. The big report is coming out tomorrow, and that's telling us how many people are actually a working employment situation. And we were expecting 1 million people. We got 266,000. So the big report's going to come out next week. Tomorrow, not next week, tomorrow. And we're going to have factory orders as well. So as far as manufacturing, as far as productivity costs, I'm not expecting anything crazy. That's not really the big picture. The big picture is the employment and the jobless claim. And we're going to find out where that stands. As I mentioned, the market's down quite a bit. If you look at the Nasdaq 100, and I will do that right now, we are once again at the 50-day moving average. And I warned you that this was going to happen. I warned you that momentum levels are overbought. As a matter of fact, here is the number of stocks in the Nasdaq trading above the 200-day moving average. And as you can see, it's 77%. And we're coming off 89%. And again, once we start cooling off, I think we're going to come down. We need to cool off. We need to go to at least 60th percentile and possibly 40th percentile. And then the market will gain the elasticity that it needs to continue moving once again. Because all of this elasticity right here, it's just momentum levels getting a little overbought. And if you look at the number of stocks in the Nasdaq trading above the 50-day moving average, the number is almost 60%. And as you could see here, that number is starting to come down. It's not moving higher, it's moving lower. And if we can break down to the 40th, we're going to be at the 200-day moving average on the Nasdaq, or in the twilight zone, which is where I think we're heading. So I wouldn't be too bullish right now on the Nasdaq. Again, we may see some volatility, but the fact that we're already at the 50-day line is not a good sign. The fact that we're here means I'm not putting bullish Nasdaq positions for at least 2 sessions. I need to see 2 days of clearance above the Nasdaq. This is a breach. If you look at the S&P 500, it does not look as bad. Let me go a little narrower here. Let me just quickly. We're still bullish on the Nasdaq one, on the S&P 500. We still are bullish on the mid cap and the Russell. Well, the Russell was never really bullish. It's just kind of choppy. but we are still trading above the 50-day moving average. So it's interestingly, but the Russell was the weakest sector, but now the Nasdaq has become the weakest sector because the Russell is still trading above the 50-day line, while the top 100 Nasdaq stocks are not. So we got to be very, very cautious. And as you could see right here, and again, that has to do with momentum levels. Momentum levels are declining, which means you should be looking at short positions in the Nasdaq and non-defensive stocks instead of long positions right now. So I got a couple for you. I got three. First stock, 𝗧𝗶𝗺𝗲, U.S. Ecology stock. Now, if you look at this stock, if you look at what they do, you will see it is a waste removal service. It's a Russell 2000 stock. It's only given us 12% over the last year, which is not a really great stock. And as you can see here, 3-year return, 5-year return, dividend yield. Dividend is a very strong sign of growth, and it doesn't look at earnings per share versus previous quarter, down 136%, down 158%. This is a dog, okay? And if the market cools off, guess what stock will be one of the first ones to go down? U.S. Ecology. Already in the twilight zone. I think it's going to break below the 200-day moving average. And when it does, it's got a nice little target of about $32. So it's at 38. I think it's going to go down to about 32. Next stock, Medallia. Now, this is an interesting stock. Medallia, MDLA. It already is trading below the 200-day moving average, but it had a gap up. And typically, these gaps get filled. And again, if you look at what the stock does, it is a service, computer IT. Computer, Nasdaq, not good. 1-year return, -7%. Stock is not a sign of happiness. Company's platforms offers learning-based artificial technology to analyze structural, unstructural data. The company is just not doing that great at all. Earnings estimates, let's take a look here. Oh, no. This is bad. This is a dog. This is a dog. And as you can see here, it is already below its low target, and I think this gap up is going to fade, and the price of 27 is going to go to 23. So I think this is a good short-term opportunity, especially to take advantage of the current market cycle. Ticker symbol MDLA, Medallia, all right? And last, finally on my list, we got R1, RCM1. It's right abutting the 200-day moving average, and if you look at the long-term chart, it just looks lower. And if you look at the profile, what does it do? Service management industry. It has a good return, but it looks like the stock is just on a service for the health industry, financial services for the health industry. Yeah, I don't know about this stock. It's a Russell 2000. Russell's choppy right now. The performance is really good over time, but it looks like this stock has peaked out technically. So it is sitting at the 200-day moving average. You may want to wait for a little pullback back to the twilight zone, but I think this stock is going to break. And if the Nasdaq breaks, if we have a little pullback in stocks, pull down in stocks, I think this one is going to see it. And it doesn't really have a strong support all the way till the $17. So again, I am right now bearish on these three stocks: 𝗧𝗶𝗺𝗀, MDLA, and RCM. I think these stocks are dogs with fleas, and we want to avoid them, especially with momentum levels on the Nasdaq falling down. Let's look at the Nasdaq, at the momentum levels on the S&P real quick. Why not, right? Why not? Ooh, oh man, this is bad. Ooh, this is not good. Let's go long term. Look at that. That is a overstretched market. That's the number of stocks in the S&P. Out of 500 stocks, 90 are trading above the 200-day moving average. That's a little steep. Let's look at the 50-day. This is more of a shorter term. As you can see here, it's moving lower. Oh yeah. See, we're moving lower. Momentum levels are declining. Money is shifting a little bit out of the market right now on a 50-day basis, on the S&P and on the Nasdaq, as you could see here. So I'm anticipating the S&P to start getting choppier, and I'm expecting the Nasdaq to turn slightly bearish. All right. As far as, let's go to Stock Fetcher. This is the last thing I'll do for you. Let's go to my filters. Let's see here. Let's see how many stocks are breaking out. We still have a lot of stocks breaking out. So it could be just narrowing of momentum, but to me, it feels like we're going to cool off a little bit, especially after this bullish move we've seen. And let me just show you something. As far as the S&P, I want to show you where the strength is. Strength is still in energy stocks, basic material stocks, energy, basic materials, some airlines or AAL starting to come up. Basic materials, airline, financials. As far as the weakness, look at this. ServiceNow, Verisk Analytics, Abbott Laboratories, tech-heavy stocks, and very defensive stocks from last summer like Clorox, Citrix. Stocks that were really bullish last summer are really bearish right now. Qualcomm, Clorox, Dexcom. Let's see here. Verizon, Netflix. Yeah, it looks like all of these stocks that were really bullish are ServiceNow, Paycom. So it looks like we're having a lot of bearishness. So these are the weakest stocks in the S&P. And let me do the same thing for you for the Nasdaq so you guys can get a good idea of what's what. Moderna, Applied Material, Western Digital. Let's see where the weakness is. Oh, yeah. Look at that. Zoom, Melly, JD, DocuSign. I mean, this is like a list of all of my favorite stocks from a year ago. Splunk, Zoom, Mercado Libre, JD, DocuSign, Verisk, Citrix. They're all right there. CGen, Dexcom, Lulu, Netflix. All of the stocks that I was loving last summer are bearish right now. Now, folks, I've got something important, timely, before you go. If people stick to trading bonds, safe ETFs, and other mind-numbingly boring trades, they could see tiny 5-7% gains on their portfolio at the end of the year. It makes sense. The S&P gives us about 6% per year on average over the last 20-25 years. But that's barely enough to beat inflation. Inflation is right around the corner. This leaves traders with only one realistic option with the potential for major profits, right? To capitalize on today's unprecedented market shift, which has been minting GameStop, AMC millionaires left and right. This phenomena has already pulled in triple-digit returns. And riding these capital floods could lead to even bigger profits, right? I mean, that's what we're looking for here. Outsized delta, outsized alpha, outsized profits. Are you ready to get ahead of the next Robinhood capital flood? I sure hope so. Click on the link below and see how it's all done. Follow the link below and see how it's all done. And folks, inflation is here. We're having some turndowns in tech stocks, consumer discretionary stocks. This is the time to get in on the Robinhood effect. It has not led us astray yet. It has been right on the money. Follow the link below, learn all about it now. And make sure to like this video, subscribe to this channel if you're watching on YouTube. Don't you want to stay ahead of the market by one step every time? Of course you do. Follow the link, follow these videos, subscribe to this channel, like these videos, and we'll notify you when we post the next one, right? Stay ahead of the market. I'll talk to you guys later. And again, keep your eye out for these three dogs, ECOL, MDLA, and RCM. Bye, guys. I'll talk to you tomorrow. It's Friday, and keep your eye on Fed data. It's coming out soon.